Ladies and gentlemen, I might offer my welcome to you. We're just waiting on a few people to enter from outside. My name's David Gallagher and I'm the CEO of the Centre for International Finance and Regulation. It's a great pleasure to be able to welcome many experts in the field today who will be talking about competition policy in Australia. We have a number of notable participants and they include Professor Ian Harper, who's currently the review chairman. We also have Professor Fred Hilmer, who is very well known in the competition space, having been the previous chair of the review, and he's also the Vice Chancellor of UNSW and a board member of the Centre for International Finance and Regulation. We're also pleased to have Professor Henry Ergas from the University of Wollongong, and Sharon Henrick, who's a partner at King & Wood Mallesons. We also have a couple of videos today that from participants who have expertise but couldn't make it today, and they are Professor George Hay from Cornell University and Professor Graham Samuel at Monash University. CIFR is a federal and New South Wales funded research centre. We do public policy relevant research in the financial market space. You might think, well, why are you doing competition? Well, competition does fit very neatly into our area. And this competition review, part of our mandate, part of our focus has been to strongly engage in terms of government reviews. And so we've been significantly involved in research and policy thinking related to the financial system inquiry. And we've also have expertise through Dr. Rob Nicholls, who's a research fellow who I'll introduce very soon at CIFR. So we've contributed in that area as well. We are led by UNSW in terms of our centre, and we have 5 other universities that are part of the consortium, and 2 research centres and 4 industry partners. We do public policy relevant research. We seek to be relevant. We seek to engage scholars who are high calibre. We are international in our scope, and we seek to be at the cutting edge of thinking in terms of public policy. It's really a good time for competition to be reviewed at the moment, and I'm very much looking forward to hearing what each of the participants have to say, including Professor Ian Harper's keynote address. So I look forward to getting to speak with you during today's proceedings, and certainly in the breakout sessions that will happen after the lunch. It's my pleasure to briefly introduce Dr. Rob Nicholls, who is a CIFR Research Fellow, and he is also an academic at UNSW in the law school. Rob Nicholls has a PhD from UNSW in regulation. So please join me in welcoming Dr. Nicholls.
Thanks for that, David. Professor Hilmer, Professor Harper, Professor Ergas, Sharon, ladies and gentlemen, hello and thanks for being here. When I was in Canberra getting ready to interview George Hay for one of the video keynotes that you'll see over lunch, I met with Professor Harper. He was slightly quizzical as to why the Centre for International Finance and Regulation should be hosting an event on competition law and policy. And it's a reasonable position to take, especially from the keynote speaker. So in framing my remarks today, I'm going to try and respond to that quizzical look. I'll do this by discussing some matters from the perspective of the financial services sector. Now, of course, this brings some issues in itself. As well as Professor Harper's review, David Murray has been chairing the financial system inquiry. Along with many watchers of financial services regulation, I'm waiting for the imminent release of the FSI final report. Now, the effect of concurrent inquiries is that the terms of reference for each reflected the existence of the other. And of course, that creates the potential for gaps. That potential can partly be addressed by the fact that both inquiries have had very able secretariats provided by Treasury. So the scope for the competition policy final report to address any competition-related issues that have dropped off from the FSI final report. And I'm sure that there are many academics and practitioners out there who will be only too glad to point out where those gaps are. And despite more recent claims, it was George Stigler who coined the phrase, "Competition is a hardy weed, not a delicate flower." However, weed killer is effective on both. And I think that the critical weed killer that Professor Harper and his team have identified is unnecessary government intervention. From the financial services perspective, the amount of regulation is often lamented. Perhaps it's more publicly lamented today than just after the immediate effects of the GFC. But there are many in the financial services sector who will agree with some of the government intervention issues that Professor Harper's draft report has raised. Just like other right-thinking people, it doesn't make sense to regulate both taxi ownership and the drivers. Safety depends much more on the drivers than the owners, and this could be baked into a business model of an Uber or a Lyft. It doesn't make sense for people in Coogee to be fined just because they put the spare room on Airbnb. I want my pharmacist to be qualified, but I don't care who owns the pharmacy. However, when the issue of the Four Pillars policy is raised, then the big banks run an argument based on the balance between competition and stability. That is, that the policy has served Australia well. Well, it's served the Four Pillars well, and it's probably served them as well as the taxi licensing regime has served taxi plate owners. Neither regime is focused on the primary foundation of competition policy, that of consumer welfare maximisation. The first paragraph of draft recommendation 1 in the draft report of the Competition Policy Review is worth restating. Legislative frameworks and government policies binding the public or private sectors should not restrict competition. It seems to me that the Four Pillars policy in the banking sector is a policy that could be removed in accordance with that draft recommendation. Now, the removal of the Four Pillars policy is not likely to result in mergers between the Big Four. It's not unreasonable to assume that the operation of Section 50 of the Competition and Consumer Act means that the analysis of any such potential merger would lead to the ACCC finding that the merger would lead to a substantial lessening of competition in one or more markets. Fundamentally, competition and contestability arise when there are reasonably low barriers to entry and exit from a sector. It's not clear that low barriers to entry exist in the retail banking sector in Australia, and evidence to support this view comes from the failure of international banks to gain a significant toehold in that retail banking sector. There are some issues that flow from the Four Pillars policy, and they include the horizontal and vertical integration in the banking sector. And there's an effect of this. It means that systemic risk becomes more domesticated and crosses multiple elements of the Australian financial system. There is a risk that the current policy fails to address either side of the fulcrum, either stability or competition. And I'd argue that it creates a potential regulatory blind spot. We're looking this afternoon at digital transformation or digital disruption in one of the workshops, but an example of digital disruption in the banking sector is the effect of peer-to-peer lending. Me lending $10 to David and only getting $11 a fortnight next Tuesday. Another one, PayPal. PayPal will provide 1 month of working capital as a loan to small and business enterprises that use PayPal. Significant entry into the retail banking sector. But the potential transformative effects of this type of disruption are those which the four pillars policy means that the regulatory regime is designed to ignore. Now, on the other hand, there are some business drivers in the financial services sector that are distinct from those in other sectors. As is, I hope, plain from my earlier comments, I don't think there should be differences in the application of competition policy to financial services sector, except where this would be in the long-term interests of end users. In assessing competition, in order to determine whether conduct has lessened that competition, it's important to recognise that risk analysis is a critical driver of conduct in the financial services sector. This means that a risk-weighted commercial decision would not be replicated by either a non-financial services firm or by a financial services firm with a different risk appetite. In my view, this issue is enlivened in respect of the proposed amendments to Section 46 of the Competition and Consumer Act. In particular, if the bank could be shown to have a substantial degree of market power in a market, then it's unlikely that either of the defences proposed in draft recommendation 25 would be available. The potential unintended consequence is that innovation will be deterred. The outcome of this is a potentially chilling effect on competitive intensity. Professor Harper, everyone has their own tuppence worth to add to the Section 46 debate. I suppose I'm approaching this the wrong way round. I started with mergers, moved to unilateral conduct, but I will round out with coordinated conduct. The extent to which critical financial benchmarks have been manipulated has been partly exposed. The LIBOR manipulation was reported by Carrick Mollenkamp and Mark Whitehouse in the Wall Street Journal in May 2008. The two journalists had looked at credit default swaps data and showed that banks were systematically understating LIBOR. However, it wasn't until 2012, with the Barclays admissions, that the behaviour became public. Since then, there have been admissions of manipulation of LIBOR, Euribor, Yen LIBOR, Swiss franc LIBOR, Swiss franc bid-ask spreads, SIBOR, BBSW, and the London 4 o'clock foreign exchange fix, a fix that was fixed. Each of UBS, RBS and BNP Paribas have admitted manipulation of the Australian bank bill swap rate, BBSW. John Jury quoted the Governor of the Bank of England, Mark Carney, in today's Australian. There must be clear consequences, including professional ostracism, for failure to behave properly. In the US, where benchmark manipulation is primarily regarded as a British or European problem, the fines have been part of a deferred prosecution system, similar to our enforceable undertakings. The legal actions have all been in the financial services regulatory space. In Europe, other than the UK, the focus has been simple. Manipulating a benchmark, whether for profit or to signal significantly lower risk than is actually the case, represents examples of price fixing and should be treated accordingly. The European Union has an immunity and cooperation policy for cartel conduct. It's slightly different to the one in Australia, as there's a discount for second in. It seems to me that the similarities between Australian competition law and the EU position mean that there's a strong potential for action in respect of Australian benchmarks. However, the consequences for manipulating benchmarks that are used in Australia, including LIBOR, are limited by the jurisdictional reach of our current Competition and Consumer Act. The recent decision in the air cargo case provides reinforcement of that. International experience addressing price fixing in respect of financial benchmarks suggests that the definition of market proposed in draft recommendation 20 is critical in the financial services conduct. That recommendation is relevantly the current definition of competition should be reworded to ensure that competition in Australian markets includes competition from services supplied or capable of being supplied by persons located outside of Australia to persons located within Australia. Now, the Centre for International Finance and Regulation is funding my research into these areas in a project entitled Competition Law and Policy in Australian Financial Services Regulation. And over the next year, the project will examine and review the competition environment in the financial services sector. It aims to identify forms of competition in the sector, the roles of financial regulators and other regulators in the promotion of competition, the extent to which there is scope for sector-specific competition regulation, and that balance between stability and competition. And the research question is simple. What are the optimal competition law and policy settings that should apply to the financial services sector? I'm looking forward to hearing Professor Harper's insights into competition policy, which I'm sure will have a more general application than my financial services perspective. Thank you.